the weekend, I read some very exciting news in Barron's about the IPO market. The article went on saying that this market of initial public offerings is so much different than the market we had back in 2000 during the dot-com bust. And the reason being, most of the initial public offerings that are coming to market this year have been around for about a decade, as opposed to only 4 years back in 2000. So companies that are coming to market are a lot more mature with a lot more underlying businesses. I remember back then in 2000, companies like Pets.com that came out without even making $6 million in sales were getting market valuations of north of $300 million. And that was good because some other companies didn't even have $6 million in sales. So comparing the IPO market to 2000 is not really a fair comparison, because back then it was a total disaster waiting to happen. And the IPO market today, even though companies that are coming to market like Chewy, that came out 2 weeks ago, a company that does about $3.5 billion in sales and got the market valuation of $13.5 billion, it's still, in my view, quite expensive, because the average IPO that is coming to market nowadays is coming out at 25 times revenues. A better way to participate in markets, in my view, is to look at companies that have solid businesses and strong growth, companies with pristine balance sheets, companies that pay dividends, companies that have a history of raising their dividends. And one company that comes to mind, although it is not cheap, is Microsoft. And why is that? Over the weekend, I saw a survey that came out by JP Morgan that interviewed 122 chief information officers, asking them where do they spend most of their money. Microsoft was the standout company in that survey, because 60% of these chief information officers said that they will increase spending with Microsoft. Amazon came out distant second at 30% of all these chief information officer individuals. And why is that? Because I think that Microsoft, under its new leadership, has better understanding of the future and the needs for companies. Their mobile first and cloud first strategies are working. They have their Azure cloud computing businesses that out of nowhere is generating north of $10 billion in sales every 3 months. And then they have their software subscription business that is doing extremely well. Also, 18% of information technology budgets are going to the cloud. But here is the good news. That number is expected to go up to 41% in 5 years, which translates to about 20% annual growth for companies that are in that space. So why do we need to go to initial public offerings that are selling at 25, 30 times the revenues, as opposed to looking at companies like Microsoft, that is the number one beneficiary of these dollars spent going forward? Other companies that come to mind can be Amazon Web Services and Amazon in general, and Google Cloud. On the negative side, companies like IBM and Oracle had negative spending intentions. IBM, I think, is an exception to the rule because they recently bought Red Hat, which allows them now to provide some sort of a hybrid cloud-based services, which I think there will be a lot of demand for it. And also, let's keep this market in the right perspective. The technology spending market worldwide is about $3.8 trillion in size. So there are enough dollars to go around even to companies like IBM and Oracle. Bernstein did the same survey and their results came a little bit different. Amazon Web Services came out first with 56% of all CIOs that were interviewed intending to spend more money on Amazon. And Microsoft came at about 49%. So Microsoft is pretty consistent with all these surveys. So we do have some good understanding that more and more of these dollars are going to go to a company like Microsoft. Mind you, Microsoft is not a cheap play right now. This is the largest company in the world with north of $1 trillion in market value, selling at 30 times earnings. If we think that they can do $5 a share next year, at 30 times earnings, that puts the stock at about $150 a share. They also have a pristine balance sheet with over $130 billion in cash, only $80 billion in outstanding debt. Net of debt, their balance sheet gives them a lot of leeway to do a lot of things with net debt of $50 billion. They pay dividends, they increase their dividends, they spend about $10 billion per year on buybacks. The profit margin is about 65%. The revenue is growing 13% per year. Therefore, I think for us as a firm looking for value, we'll get more results for the risk we take with existing companies as opposed to initial public offerings.
Okay, so I'm going to cover a little bit about mergers that are going on in the healthcare industry right now. Centene is a stock that I talked about in the past, which processes Medicare and Medicaid payments for the government. And they were just cleared to complete a $15.3 billion acquisition of WellCare health plans. The U.S. Department of Justice has requested more information, so this thing might be delayed a bit, but they think that this thing will continue on. The other part of the problem is that the U.S. Supreme Court will hear a case on healthcare insurers that for about $12 billion in funds as a result of a lawsuit that centers around the program for the Affordable Care Act. And they were supposed to subsidize insurers for taking on the risk of non-insured people. Basically, the government suspended their payments on that, and the lower courts upheld it. So now it's been pushed into the Supreme Court. And players like Anthem and Humana are part of that lawsuit. United Healthcare, on the other hand, agreed to pay $3.2 billion for Equian, which processes more than $500 billion of annual healthcare claims. And that's going to open up other portions of the business for them as well.
So we often talk about 5G because it is at the nexus of one of the super cycles we examine in several of the companies that we are invested in, and so we're closely watching it. Carriers are already rolling out 5G to several cities, and the total adoption date is set to be around 2023. This will obviously vary by different geographic locations. Some countries will be adopting more than others, but no doubt the US and China will be some of the main adopters of 5G, especially by that 2023 deadline. By this point, the market will reach an inflection point in 5G and will hit 800 million 5G devices, which is 51% market penetration for 5G at that point, which is on top of the growing 5G handsets, which will total 1.9 billion by 2023. So back in 2011, China surpassed the US as the largest smartphone market, but with the contraction of the Chinese economy, so has the smartphone market.
As of today, the 10-year is still sitting at 2.01. The 2-year and the 10-year has still not inverted as of Friday. That spread remained at 25 basis points. Short-term rates on the 1 and 3 month to the 10-year have remained inverted at about 12 to 15 basis points. The 2-year and the 3-year remain inverted pretty consistently for a couple of weeks now. It'll be interesting to see what the ISM numbers on Wednesday and then the unemployment numbers on Friday have to do as far as what's going to happen with these rates going forward.
Hello everybody, and thank you for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. As always, if you like the content, become a subscriber to our YouTube channel. You can also call us directly to our main offices at 818-914-7461. The highlight of the week is that investors should not necessarily always chase just growth companies, especially with IPOs, initial public offerings, where most of the companies that are coming to market sell at 25 to 30 times revenues. Occasionally, it's not less important to look at established companies that serve the same space with better risk-reward parameters.